So a subscriber was just asking me about stock splits. I'm a long-term investor. I invest for dividends and cash flow for passive income that can pay my bills. And I own over 30 stocks. Some of them have split over the years. And a subscriber was asking me, hey Ian, what does a stock split mean to you? What is a stock split and what does it mean to your strategy? Are stock splits important? Are they inconsequential? How do they factor in to your overall investing strategy for dividends and cash flow? Well, I'm going to respond to that question in today's video. Hey everyone, I am so excited to have you here. Thank you for tuning in to the PPCE and YouTube channel. My channel is about dividends and cash flow, investing for financial freedom. And today's video is in response to another subscriber question. Please keep them coming. I look at all of the comments. In fact, I try to respond to all of the comments. And today's video is just that. It's a response to the question about stock splits. And so I own over 30 stocks. Some of them have split over the years. In fact, I tend to experience a stock split probably about every other year. It's been a little bit longer now. I haven't seen as many recently, but they usually come along maybe one every other year or so. So what is a stock split? A stock split is basically when a company, its share price has gone up really high, and that company decides, hey, you know what? I don't like this high share price because it makes my stock unobtainable to the average investor. The average investor sees my share price, it's at $100, $200, $300, and it gives them sticker shock. It makes it hard for them to purchase my stock. And it makes sense. Like, let's say the average investor has maybe $500 to invest. Let's say that the share price of a certain stock is $300. Well, unfortunately, the average investor can only buy one share because if they wanted to buy more, $200 left, 500 minus 300, it's not enough for a full share. And so it really makes it harder for the average retail investor to invest when these share prices are really high. Now, obviously, for those that watch my channel, you all know that there's ways around that with direct investment through transfer agents, with dividend reinvestment plans, with other disruptive technologies. There's ways around it. But that being said, most people use a broker, and that is a real challenge that smaller investors can face. And so a company says, hey, my share price has gotten really high. I want to split the stock. And what they do is literally, they will do typically a 2-for-1 stock split or a 3-for-1. And what this means is for every share outstanding, if they do a 2-for-1, they're going to double the shares. They're going to say, I'm going to match every share with a new share. And when they do that, the price gets cut in half. Or they'll say in a 3-for-1, hey, for every share you own, you're going to get 3. And the value, the price per share, it's going to get cut by 3. And so there's no net wealth creation here. There's no magic or mystery behind it. What literally is happening is it's something just to take the share price down and make it more accessible to investors out there. And obviously the amount of shares outstanding goes up. If it's a 2-for-1, the shares outstanding doubles. If it's a 3-for-1, it triples. And so one is going to have more shares, but at a lower price. So to make this concrete, I think it's easier to take an example. So let's just look at this. This is a 2-for-1 stock split example. Let's just say hypothetically, I own stock. I own it in a company. I own 100 shares at $100. And so let's say all of a sudden the company says, I'm going to do a 2-for-1 stock split. I'm splitting the stock here. And so what happens is, here's this dashed line. This is the stock split, 2-for-1. Pre-split, I own 100 shares at $100. Post-split, what happens is, okay, now I have 200 shares, and they are each worth $50. You can see the $50 down there. And so literally, there is no net wealth creation here. Before, it's 100 times 100 or $10,000. After, so $100 a share times 100 shares, 10,000. After, it's $50 a share times 200 shares, or again, $10,000. So the net aggregate value of my stock, it's the same before and after. It just so happens that now I have twice as many shares, but at a lower price. And now that's a 2-for-1 example. If it were a 3-for-1, what would simply happen is instead of 200 shares, I'd now have after the split 300 shares, but they wouldn't be worth $50 a share. They would be worth $33.33 a share. It would be 100 divided by 3. And so the purpose of this illustration is there's a lot of hype, there's a lot of press, a lot of media when stocks split. It's a big deal and it gets hyped up. I think a lot of people who are newer to investing hear that there's a stock split and it almost becomes a reason to buy a stock. It almost becomes this big thing. And my philosophy from a very long-term perspective is it's a non-event. It really doesn't matter whether there's a stock split or not. In the long-term scheme of things, it's not going to make my investment better or worse one way or the other. That being said, there's a lot of hype around it. And I think people just get excited because all of a sudden they own 200 shares instead of 100 shares. And it's exciting. And maybe it feeds the ego a bit. It's like, wow, now I own twice as many shares. But really, the aggregate value of what you own, it's the same. It's just now you have 200 shares, but they're all worth less. And so something to keep in mind. Now, one really important thing from a stock split perspective that I like as a dividend investor is a company will typically not split its stock unless the management team, the board of directors, are very, very confident. They feel good about the future of the company. Because think about it. If I split my stock, my share price goes from 100 to 50. Let's say the company falls on bad times. And let's say that $50 share price goes down to like $20. Most world-class blue chip companies don't want a stock price in the $20 range. And the reason for this is institutional investors, they have rules that they follow. And certain rules in certain institutional portfolios say, hey, you're not going to buy a stock that's worth less than X amount per share. It's just rules. They just exist. And they exist to keep the institution safe, to make sure they're investing wisely. And so if a company splits its stock and they're not confident and they're worried that things are going downhill, they would never split the stock. They just wouldn't do that because it could create risk. It could create triggers where institutions not only may have to sell their stock, but maybe can't buy it back until it reaches a certain point. It just creates a lot of challenge. Now, also, there are certain regulations. If one stock is listed on certain exchanges, like the NASDAQ, for example, the share price has to be typically for certain exchanges at a certain level. And again, if the company were not very confident in its business, they wouldn't want to risk splitting the stock, having it go down, and then not meeting their requirements. And so the fact of the matter is when a company splits its stock, typically the management team and the board of directors, everyone, they are very, very confident. They are super confident in the future of the company. And so for me, as a dividend investor, a long-term investor, I hold for decades, if not forever, for cash flow. I like that. That's another sign. If I see stock split, I'm like, okay, now this company knows what they're doing. This company feels good about the future, and it's a positive from that standpoint. Now, something else worth mentioning with a stock split is sometimes you'll get a short-term bump. When a stock split is announced, just for the very, very factor that I just mentioned, the Wall Street takes notice. They're like, yeah, management team is confident in this stock. They're happy about this stock. They feel good about their business. And you might see a little bit of an uptick. Usually that uptick is short-lived. It's traders and swing traders, day traders taking advantage of the short run. That's not me. It's just not what I'm about. I know a lot of people make money that way and they trade and good for them. For me, I buy and hold. And what I've always found is these short-term blips, especially when a stock split is announced, they're kind of short-term. They'll usually, kind of even out over time because, again, there's no material impact on the business here with a stock split. It's simply a means to getting the share price a little bit lower to make things more manageable for most investors, average investors out there. And so I think in the short run, people are like, yeah, management's confident. They might bid up the stock, might go up a bit, but it usually kind of evens out over time. So one thing worth mentioning from a stock split standpoint that's helpful for a dividend investor is record keeping. So I like to keep really good records. I keep them in Excel. I write down all of my buy orders, all of my reinvested dividends, all of that kind of stuff. And I don't want to get into the details today because I just don't have Excel in front of me. One of my goals here on my YouTube channel is to do some videos in the future where I am speaking, and you got a little picture of my face speaking, but you also can see my computer screen and we can go through some metrics and such. And so in the future, I'll probably do some videos on Excel spreadsheets, but right now I don't have it in front of me. But needless to say, the key point here is if one is keeping good records, one needs to adjust their Excel spreadsheet to reflect the stock split. And so pre and post split, one is going to have twice as many shares. And so typically I like to make an adjustment. I'll have a line item when the stock split happens, and I'll say, hey, 2-for-1 split. I'll take my shares that I had before, and then I'll double them if it's a 2-for-1, and that's how many shares I have now. Cost basis stays the same because the cost I paid for all of those, it's the same. And again, the current market value is the same. It's just twice as many shares at half the share price. But it's key for me to make these adjustments in my Excel spreadsheet to reflect the stock splits. Otherwise, in the future, if I didn't do that, it would just be a mess to kind of go back in time and figure things out. I'm like, wait, did I really buy at this level? I didn't make as much as I thought, or it just gets confusing. And so if you are keeping good records, which is something that I think is really important for long-term investors, it's just important when a stock split happens. It's another reason to get into the Excel spreadsheet and make sure to reflect the stock split. So one other thing on stock splits, and I really hope you never experience one of these, and they're kind of rare these days, especially with large blue chip companies, with world-class companies. I haven't seen this happen for a long, long time. But one thing to point out is there's this concept of a reverse stock split. So if a company's share price gets really low, usually it's trending down. This is a sign of a company that's not doing well. Sometimes there will be what's called a reverse stock split. So for every 5 shares you own, for example, it becomes 1. And then the share price so you own less shares, but the share price will go up. So you'll see stuff like that with companies that are really failing. They're not doing very well. It's kind of a very bad sign if a company has to do a reverse stock split. But again, this is very rare. Hopefully you will never have to experience something like that, but I'm pointing it out just in case you see it out there in the marketplace. And usually when things have gotten as bad as having to execute a reverse stock split, the stock has already fallen quite a bit. And so hopefully there are, for savvy investors, there are usually signs leading to something like that. And usually a savvy investor will probably figure out it's best to get out. It'll be one of those rare cases. Look, I rarely, if ever, sell stocks. Well, I do from time to time, but very rare, very, very rare. And because I buy and hold forever, I am buying for the cash flow. I buy to never sell. But reverse stock split, this would probably be the case where you would get me to sell, and you would get me to sell even before it got that bad, because the fundamentals just would have deteriorated so bad by that time. So a fun video today. One thing I want to point out is I'm now on Instagram. I'm starting to get questions there. I'm going to link to it in the description below. I love the comments here on YouTube. I'm also trying to branch out as well. And if you have any questions, comments, feedback, bring them over to Instagram as well. I'm active on there. I'm checking it all the time on my phone, and so you can engage with me on Instagram as well. If you liked the video today, I please invite you to subscribe, to like it, to comment. It means the world to me. And one thing I learned recently is if you really like my videos and you subscribe, there's this little bell next to the subscribe button. Click on the bell as well, because that makes sure that you'll get alerted whenever I have a new video. Something I learned recently, and so I don't know if you're not taking advantage of that and you want the most up-to-date PPCE and dividend videos, click that little bell. I really, really, really appreciate it. Before I leave today, a friendly disclaimer: I am not a licensed investment advisor. Today's video, it's not investment advice. I'm just here sharing my passion on YouTube. This video is just for fun and entertainment. If you are going to go out and invest in the stock market or anywhere else, please do consult a licensed financial advisor first. Thank you so much for being here, for being on this channel, for supporting the community. It's really exciting to see how quickly PPCE is growing here on YouTube. At the end of the day, it's all about long-term investors, dividend investors, empowering other dividend investors. And what's so fun about this topic, it's so different, it's so contrarian to what everyone else in the financial world, the ways that a lot of people look at things. And so it's fun that we can all get together here on YouTube, on this channel, and talk about our passion for financial freedom and cash flow. Because at the end of the day, it is so fun to be earning money when one is sleeping. Let's get our money working for us. Thank you for watching. I will see you in the next video.